Hello, everybody, and welcome to this week's podcast. Today is May the 3rd. I'm Jay Gragnani, and here joining me this week is Ian Saunders. Ian, great to have you on this week. We have a great discussion. This time of year, April is now done, May has kicked off, and at least as it relates to the stock market, this is the time of the year that we begin to hear the adage of sell in May and go away begin to pop up. And the premise behind that sell in May and go away idea is that there is a seasonally strong period that exists in the market historically and a seasonally weak period in the market. And the sell in May and go away kicks off what is known as the seasonally weak 6-month stretch in the market. And that stretch is from the beginning of May through the end of October. So basically, through a bulk of all of the summer months and a beginning of the spring and kind of the beginning of the fall. But that May through October period historically has been seen as the seasonally weak period in the market, which means we just concluded and wrapped up what has historically been marked as the seasonally strong period in the market, and that period being from the beginning of November through the end of April. So last Friday, April 30th, wrapped up the month of April. It wrapped up the seasonally strong 6-month stretch that we've experienced in the market historically. And we wrapped up on a very positive note with the Dow Jones specifically rising about 27% from the beginning of November through the end of April, which that historically is a very strong 6-month stretch for the market. That is the best performance that we've seen during that seasonally strong period since going back to 1985. But this idea that we sell the market and go away and we go on vacation for 6 months and then come back at the end of October and begin to put money to work, that concept and an idea, there's a lot of historical data that suggests that a bulk of the return in the market comes during the seasonally strong 6-month period. It doesn't mean that it happens, it doesn't mean that the market can't go up or be positive in a weak period. But when you just historically look at the numbers, Ian, there is a very strong bias towards this idea that the markets just tend to do better during the strong period from November through the end of April.
That's absolutely right, Jay. And in looking, we have a variety of studies that look at this aspect of market seasonality and some models that look at applying the seasonality aspect to rotation, which we'll get into in just a bit. But in looking at one of our studies that looks at historical returns for the Dow Jones Industrial Average from April of 1950 up through present. As you said, we saw a return of north of 27%, actually 27.83% during the most recent seasonally strong period from the beginning of November of last year through last Friday, which, as you said, was one of the highest returns we've seen during that seasonally strong 6-month time frame and throughout the entire history of our test. But in looking at breaking out the returns for the Dow. So let's say if you were going to come in, you were going to only going to hold the market during the seasonally strong period, or you were only going to hold the market during the seasonally weak period. So if you would invest in a $10,000 portfolio back at the beginning of our test, looking at the Dow Jones Industrial Average during just the seasonally weak period in the market, or just the seasonally strong period in the market, beginning back in April of 1950, investing just in the seasonally weak period of the market would have grown that $10,000 portfolio to around $12,000 based upon the most recent ending of last year's seasonally weak period. However, if you invested that same $10,000 during just the seasonally strong period in the market, that $10,000 portfolio would have grown to north of 1.2 million as of the most recent data through market close last Friday. So while neither of those portfolios beat just buying and holding the Dow throughout that entire time frame, as just buying and holding from the end of April of 1950 would have grown that $10,000 portfolio to north of 1.5 million. We see that the bulk of those returns, almost all of the positive movement from that portfolio, has occurred during the seasonally strong period in the market. Which is certainly an interesting thing to note. Now, that does not necessarily mean that we're going to should be on the lookout for negative returns over the next 6 months. As we ended the last seasonally weak period from last May through October, we saw a positive return for the Dow of almost 9%, of right at 8.8%. And we're actually continuing on the second longest streak of positive returns for the Dow during seasonally weak periods throughout the history of the test. we've continued to see those returns come through to demonstrate positive returns for the Dow during the seasonally weak period, going back from 2016 up through present. So we'll see if we can continue that streak here, Jay, over the next 6 months to now move from tied for second to tied for first for continuing positive movement over the next 6 months. But definitely some interesting market movement here to keep an eye out for.
Yeah, that's right. And I think, the numbers are certainly there to suggest that the sell in May or market seasonality is certainly a real thing. Over the years, there is certainly a very strong bias. But that is all to say that, that is not necessarily the be all end all of risk management in terms of just when we turn the calendar, because you mentioned it, we're 5 consecutive years, 9 out of the past 12 years during the seasonally weak period, the market, at least as defined by the Dow, has been in positive territory. And so, as we move through end April and move into May, the question now becomes is, do we need to adjust our game plan going forward? And there's some things that we certainly could do in the market. I mean, typically and historically, just like we've seen a lot of the return come from that seasonally strong period, there also tends to be a strong bias towards certain styles or certain factors that work better during the seasonally strong period in the market compared to those that tend to work better during the seasonally weak period. Because if we go back historically, I mean, while there's been a number of recent positive seasonally weak periods in the market, there also have been some very negative seasonally weak periods out there in the market. And just to kind of put that in perspective, going back to 1950, there's only been 3 seasonally strong periods that have seen a negative return for the Dow of 10% or more. So a double-digit loss for the Dow during the seasonally strong period, only 3 times versus 11 times that's occurred during the seasonally weak period. And so, the seasonally weak period also encapsulates September, the month of September, which historically is the worst month of the year for the market. And then October historically is a pretty volatile month as well. But the summer months often tend to be relatively quiet in terms of overall volume and stuff in the market. Last year, notwithstanding, obviously, with everything going on with the pandemic, a lot more volatility in the market, a lot more volumes taking place in the market last year. Nonetheless, there certainly is this bias towards certain factors that work better. One of those factors that tends to work better during the seasonally strong period is growth or momentum type of strategies. That's a period of time that the market has seen a higher willingness or higher degree to benefit and favor those factors like growth and momentum versus things like low volatility. That factor tends to do much better during seasonally weak periods in the market as the markets do tend to calm down a bit, at least in terms of some of the numbers that you went through. And so one way to approach the market today, as we're moving into the sell in May, go away, well, one way to approach it would be to sell everything on go on vacation for 6 months, which given the events of the past year and a half doesn't sound all that bad of an idea. But the reality is, one thing that you could do if you wanted to adjust a portfolio to take advantage of this kind of seasonal bias in the market is overweighting low volatility over, say, a growth or momentum type of strategy. And we have a number of guided models on our website that do just that. But the idea is that during the seasonally strong period in the market, we want to overweight momentum type of strategies. Not only does the market tend to support that's where we tend to get a bulk of the excess returns, but a lot of the data that we've looked at suggests that even during those seasonally strong periods, being in something like a momentum type of strategy has done even better than just being in the market versus the seasonally weak period. So the idea is that if you have a portfolio, if you have 2 positions, say a momentum and a low volatility ETF that you hold as a piece, or maybe it's just a piece of the overall portfolio, maybe you have a seasonality slice that you incorporate as a satellite position in a portfolio. If you have 2 ETFs, one momentum and one low volatility, during the seasonally strong period, you would want to be overweight momentum during that time period and underweight low volatility. So maybe that looks something like 70% in momentum and 30% in low volatility during the seasonally strong period. And then come May 1st or the beginning of May, then you might want to adjust that to say, now given the seasonally weak period that we're engaging on, maybe we want to now overweight low volatility. And so instead of 70-30 towards momentum, maybe we go 70% low volatility and 30% momentum, just as an idea. Again, we've got some models on the website that do that if you have access to our website. If you don't, I would encourage you and welcome you to go to our website, sign up for a free 30-day trial of the research platform, especially right now at the beginning of May as the seasonality is just fresh and is rolling out right now. Go onto the website, click on the models page, and you can see a lot of models, Ian, not just a momentum versus low vol type of rotation portfolio, but we have a number of other models available that do take advantage of this market seasonality.
Absolutely, Jay. And in looking at the momentum low vol, like you said, we have some models that that are going to be seeking to overweight that low volatility aspect over the next 6 months. And in looking at another area on the platform, looking at a page that we call the asset class group scores page, which takes all of the ETFs and mutual funds and classifies each of them into at least one of 135 different groups, and then ranks those groups according to the average fund scores of those group constituents. In looking at those from the factor perspective, low vol has been one of the areas, as you said, that hasn't really kept up with most of the broader market, and especially some of the other maybe momentum-driven factors over the course of the last 6 months to a year. But we've seen that low vol group has improved recently to cross back above our 3.0 score threshold over the past month, putting us on a more positive footing as we head towards this seasonally weak period. So definitely another area to keep an eye out for those that are looking to potentially take advantage of some of those strategies. Some of the other strategies that we look at are our fund score method or FSM models, which are going to look to capture the aspect of market seasonality, but in a slightly different way. These models also utilize the fund score system. So that fund score for ETFs and mutual funds, it goes from 0 to 6, 0 being the worst, 6 being the best. And we're going to take an inventory of funds and simply rank those funds by their fund score at set evaluation points throughout the year. Many of those models are evaluated on what we call a seasonal quarter basis. So trying to capture this idea of market seasonality and look to evaluate those models during potentially major shifts in thematic moves in the market on these seasonal basis. So those models are going to be evaluated based on a market close tomorrow. So based on closing data from Tuesday, May 4th, and any subsequent potential trades that would come from those models are going to be sent out on the morning of Wednesday on Cinco de Mayo on May 5th. So for anyone that follows the models there on the platform, definitely be sure to make sure you have the alerts set on those to be notified of any potential changes that might be coming forth.
Yeah, that's right. That reminds me, Ian, I need to go in and check that as part of our FSM model later this week. And you mentioned Cinco de Mayo, and I can't help now. The Kentucky Derby was this past weekend, and this time of year is typically the time of year where we are hosting our spring Point and Figure Institute, which until last year we did out in Las Vegas for a number of years prior to that. We just wrapped up last week a virtual spring event that we conducted. It was about a half-day training session in lieu of an in-person event in spring out in Las Vegas. And we look forward to 2022 being able to host an in-person event in the spring, likely out in Las Vegas. Stay tuned for that for those of you interested. Although we are planning on, in the fall of this year, hosting an in-person Point and Figure Institute here in Richmond, Virginia. That's going to be in November in Richmond, Virginia. Again, that is at least our plan at the time being, is to be in person. If that's something that you would like to get information on, please let us know. You can send an email to dwa@dorseywright.com if you want to, and just put in the subject line Fall Institute, and we can make sure we get you on a pre-registration list to be notified once registration is open. Registration is not quite open for that now, but we will be getting that open, and we will notify you when that does become available, if that's something that you're interested in. So please let us know. With that said, I think that's all we had this weekend, and really the topical discussion of market seasonality, it is certainly something that has a strong bias to it. When you go back and you look historically at the numbers, there is a very, very strong bias towards this idea that the markets tend to do better during the seasonally strong versus the seasonally weak. But it does not suggest that the market has to do poorly or be negative during the seasonally weak period. So that is important to keep in mind. We will continue to focus and monitor our attention on the indicators, but now is a good time of year if you are looking to at your portfolio, looking at your holdings, making sure that those positions that are in there, that the areas of the portfolio continue to line up with where the leadership trends in the market exist. So with that said, Ian, thank you for joining this week. Appreciate the discussion. Always great to have you. And for everybody out there, thank you very much for joining us for this discussion this week. We appreciate your time and look forward to talking to you next week.